a technical issue, and that is why we are straight away coming to the point. Today's topic is very interesting: strategies that don't need markets to generate returns. Over last 2.5 years, we have seen markets have been actually very favorable for long-term equity investors, especially as well as traders. But at these levels of markets, a lot of investors are skeptical, and I think the more investors are skeptical, the more markets are actually rising. However, to deploy one's money and in an asset allocation, there is a role which is played by some of these contemporary strategies, which are managed by skilled portfolio managers. There have been many popular names in this space, and this space is actually known as long short funds. And there have been names like vendors, Edelweiss, Tata, DSP, which have been actually doing good work in terms of creating and innovating some of the products. But the performance has not been consistent, and performance have been actually evolving over time. And they have actually, taken 1 hour from Harsh Agarwal, who heads alternates at Tata AMC, which is actually doing the best work in this area in terms of performance and in terms of risk-adjusted returns, because this is the area where risk-adjusted returns is what matters the most. And that is where we studied standard deviation, we studied Sharpe ratio, we studied performance over a period of time in terms of monthly returns, and realized that yes, there are few players which are actually delivering consistently well. And that is where Harsh Agarwal's skill set comes. And that is where I contacted him and thought of learning from him what is this space all about and what are the various strategies which actually are delivering returns. And today we will first hear it out from Harsh. He has prepared a very refined presentation which is basically educative in nature and which will kind of teach us that what are these strategies, how these strategies actually function, can investors directly deploy these strategies on their portfolios or not, and what are the things to be what are the do's and don'ts. So over to you, Harsh. And also to kind of give you a perspective, all the viewers, Harsh comes with 18 years of experience. He has been particularly doing long short strategies for more than 1 decade. And now when Harsh would have given his presentation, we would also want to understand from him various real questions, because we deal with investors every day, and I can tell you, there are many real questions regarding particularly these strategies that I have in my mind, which I will cover after you have spent maybe first 20-30 minutes covering a presentation. Over to you, Harsh.
Thanks, Kamal, for this kind introduction. Welcome everyone to this discussion. I believe this will be a very fresh discussion in terms of what we are going to learn today, what we are going to discuss today. The topic today is strategies that don't have to rely on the market or market support to make returns. Just think about it. Strategies that don't have to depend on market to make returns, to generate returns. And I think if you look forward for about next 10-12 years, this understanding or this concept will become more and more important. So before we discuss this topic, I want to first appreciate PMS AIF World. They have been doing some fantastic work in the world of alternatives. I believe that they gather the data on a regular basis from all the PMSs and AIFs, and their evaluation is fairly scientific, and which helps investors, and they can give scientific and statistical analysis based advisory to the investors, and which I think is the right approach. So really commendable job, Kamal. I also want to thank my colleague Nitish Pandey, who has helped me in assembling and presenting this data that I'm going to do now. And at the same time, I also want to disclose that some of these points or concepts that we are going to discuss today, and which I will share with you, are essentially born out of my own observations. They and therefore they could be somewhat biased as well, and they are not necessarily the thought processes shared by my colleagues or the people that I've worked for, or the organizations I've worked for in the past. So these are purely mine, and hence subject to bias. So today we are going to start, something about understanding these strategies. But before that, let me tell you some basic points about the market. So to make the popular strategies to make money in the market are essentially three. One is the time you spend in the market. Second is timing the market. And third, and probably the most important, is alpha extraction. Now I will go through them and I will build the context of how this is related to generating independent returns. Now, if we were to divide the products basket into long onlys, which is your mutual funds, PMSs, and long only AIFs, and long short products, which come under category 3 AIF long short hedge funds. So we will evaluate, what are these funds doing to make some returns for the investors, which are not linked to the market and movement. So if you look at the long only products, typically mutual funds, PMSs, they are by and large dependent on the market forces. If markets fall, they will fall along with it. If markets rise, they will rise along with it. Some funds, will give you some kind of alpha, some kind of deviation from the market returns, and which will reflect over a period of time in terms of superior performances as well. But by and large, they have one strong tool through which they can de-link somewhat to market movement, and that is the alpha extraction. Now, what is this alpha? So, often we define alpha like the excess return over your benchmark. While it's the right definition, and let's say if the market goes up by 10%, the portfolio goes up by 15, so your alpha is 5. Uh, on the contrary, if the let's say markets fall by 10 and you're falling only by 5, still your alpha is positive 5. If you underperform your benchmark, then you are getting a negative alpha. While this is one way of looking at alpha, the way I look at alpha is this. Assume that, let's say, the market remains kind of flattish for next 3-4 years. Then do I want to buy a stock today which will give me a positive return in future without the market support? So when you develop this kind of thinking and evaluate the stocks, you are essentially trying to get alpha stocks in your portfolio. And this is the thinking that goes into long some of the long only portfolios. And assume, let's say, we do come across a stock, we identify a stock which we believe should do about 10% per annum returns, even if the market remains flattish or maybe it's slightly down. And it does that. So let's say market goes up by 10%, then probably it will go up by 20. When market remains flattish, it is going up by 10. When market is going down by 10, it is probably landing at 0. But it is still getting disconnected with the market somewhat and is giving you an alpha return. So this is the strong tool that long only fund managers have, and this should be the predominant focus of long only products. But when we come to, let's say, long short strategies, there are far more many tools to de-link your portfolio with the market movement. And the first one is the long short strategies. Now, what is long? What is short? So long is simply having a buy position in a scrape or in market. You simply just own something. It could be created through derivative positions as well. Short is something where you have a sold position in a stock or an index without actually owning it. So basically, if let's say you short a stock and you don't own it, the price goes up by 10%, you will stand to lose by 10%. On the other hand, if the price of that stock or the index goes down by 10%, you will gain by 10%. So short positions essentially make money when the stock or the underlying falls. Long positions, on the other hand, they make money when the positions basically rise. So this is long and short as a concept. Now, what long and short funds will do is basically build a portfolio of stocks. So they will have some stocks which they believe will rise, and then they will have a short basket of stocks which they believe will fall. So under this kind of a portfolio construct, what you will get is a better returns outcome, a better risk adjusted returns outcome. I'll give you an example. So if you look at let's say last 3 months, starting from July till now, our market has risen by 12-13%. I'm talking about Nifty. And if you look at Maruti was around at 7,700. Today it is down by about 10% from those levels. So when the market is rising, it's not that all the stocks are going up together or they are going up uniformly. In fact, there are some stocks which actually go down. So for a long short portfolio, the fund manager essentially look at what kind of stocks will outperform the market, and what kind of stocks will underperform or will fall in absolute terms. And basis their analysis, they will design this long short portfolio and try to profit from both the sides. While it is not possible always to get these alpha rights, but at least you have the tools to generate alpha on both long and short side. Now think about it again. When you invest in a PMS or a mutual fund or a long only AIF, they have this long alpha side as a tool with them. But when you invest with a long short fund, the long short strategy essentially enables you to capture both the long alpha and the short alpha, and which is the unique opportunity that these long short funds or this long short strategy possesses. The second is market timing. If you are good, in timing the market either through technical analysis or quantitative, or even fundamental or macro driven, you could basically create a position in the stock or the market and trade along with it. Having said which, I think it's pretty difficult for any human to time the market perfectly. There are examples, and we have examples where quantitative funds have done it very accurately. But generally, it's very difficult for humans to time the market correctly. And so these are the two broad strategies that long short funds have in terms of developing a long short portfolio. Besides that, they also have options as a strategy. Now options again has multiple strategies that you can run to make returns which are not linked to the market. So some of the prominent ones are, popular ones are delta hedging, then covered calls and spreads, and so on. We will not discuss these in details. These are fairly complex, but there is very good content literature on the options. There are some good videos as well. So anybody who's interested to understand options more can easily go and search. But what we are trying to essentially establish here is that the long short strategies have more tools with them to generate some returns which are not linked to the market. So it's totally possible, because of their long short strategy or because of use of options trading, they are able to generate some returns even when the markets are flat or even when the markets are going down. So that is the beauty of long short. However, having said this, this will require a lot of skill, a lot of practice, and it will be significantly more difficult than plain vanilla longs. But there are more tools, and this is something which in an environment where there is more uncertainty, volatility, and if the market somehow enters a weak phase, this will stand out quite well. Now, as we discussed, long short funds have far more many tools to generate these returns, which are not kind of linked to the market. We will try to see whether it is getting demonstrated in their performances as well. So we have gathered this data from PMS AIF World. They essentially gather all the returns data from all the AIFs and PMSs on a monthly basis. So we have taken the data from starting from March 2020 and ending till August last month. So this is a full 18-month period. The reason we have covered this phase is because March 2020 was a month when the markets crashed. So we wanted to see how the funds have done in this phase, and then there were some volatile months, and then a very strong bull phase. So to understand how these funds are performing, we kind of have to get a picture of how they are doing in different phases. So we have plotted the performances of some of these long short funds. The y-axis essentially here tells the returns these funds have made. So higher the bubble is, the better returns it has generated. And the x-axis denotes the risk or the volatility that the fund has taken to generate those returns. So this volatility is essentially computed through standard deviation, and you analyze that. So rightward you go, riskier the fund has been. So more volatile the fund has been. So if you look at fund A, its volatility is kind of close to 24%, which when we tracked was kind of similar to Nifty's volatility, although Nifty delivered better return in this phase. But we are purely comparing, long short funds here just to understand whether they are delinking their returns to the market or they are playing along with the market. Then you have fund E, which is slightly less on returns, but it has meaningfully reduced the volatility of the risk. And then you have I, D, and T. But what's really is surprising is that since these 18 months, the market has by and large been strong. So at the end of February 2020, March, I think index was somewhere around 11,000, and today it is at 17,000. Or at the end of August 21, I think index was around at 17,000 or so. So the market has risen nearly 55 to 60%. So ideally, the funds in such a scenario which are taking large risk should be benefiting most. If the markets was, let's say, range bounded or gliding down, then higher risk would not have rewarded as much. But in a bullish scenario, higher risk should have played out very well for those funds. But we are seeing some exceptions here, and it's an early indication that some of these funds have done something which is unrelated to the market. So if we were to analyze it deeper and go into the numbers, what we'll find is we'll try to analyze their returns and some of their volatility numbers to understand what exactly has been happening. So if you look at the first two rows, it's basically talks about how much returns they have made, and clearly the standout is fund T. One is absolute returns, which means point to point returns, and then the CAGR returns, which is how much they have made on a compounded basis. Next, we see their riskiness that the funds have taken. So we see fund A has taken fairly large risk. The volatility is quite high and almost equivalent to Nifty. Then there is fund E, which has slightly less, and then from I, D, and T we see that these funds have been fairly conservative in nature, and they have hardly taken risk. So six out of 24 means nearly 1/4 sort of a volatility relative to fund A. While Nifty's own volatility was somewhat higher than this, but so we can dissect basically these five funds broadly into two baskets. One is TD and I, which are more conservative or which are taking less risk, and then E and A, which are taking kind of higher risk. And it's also exhibited in their beta profile. So beta is the sensitivity of your fund returns to the market. So it's kind of directly telling you how much returns the fund has made due to markets going up. So it's direct linkage of your fund returns with the market. So again, we are seeing that D, TD, and I are kind of de-linked somewhat. They have very low beta profiles, nearly 26%, 21%, and 16%. And E and A have much higher linkage to the market, about 65% and 86%. But what is strange here is that even though fund E and A have very high linkage, their returns are kind of similar to let's say fund I, which is highly de-linked to the market, and fund T is doing something on its own. We will still have to dig deeper and find out what it is doing. Then we have what we call as Sharpe ratio. Sharpe ratio essentially talks about your returns divided by risk. So if your Sharpe is higher, it is better. Even in the slide below, we showed you the fund returns plotted on X and Y axis, and the size of those bubbles were basically indicative of Sharpe. So higher the Sharpe, bigger the bubble, and the better it is. So if your returns are higher and risk is lower, your Sharpe will expand, and which is a good indicator. If let's say you are taking high risk and then making high returns, so your returns will kind of become commensurate with the risk, and therefore your Sharpe will not expand as much. So you will see that in fund E and A, while their returns are pretty healthy, 39%, 41%, their Sharpe performance is quite sluggish, which means their returns and risk are kind of similar. But if we come to I and T, their Sharpe is quite meaningfully high. In fact, for T, it is substantially high. So it is taking far lower risk and still doing fantastic in terms of returns. So we dig deeper and try to find out what the other matrices as well. So if we look at the number of months or percentage of months that it has generated positive returns, so it's fairly healthy across the board. And again, Fund T has some 94%, others are at around 70%. Then we checked out with some other matrices. So we looked at the fund returns whenever the index was positive. So what we found was that E and A are having very good returns when the market is positive. That's 4.2 and 5% respectively. And others being conservative have lesser kind of capture on the upside. Fund T still has decent about 3%. Then we look at the monthly returns when the index was negative. So this is a very, very critical way we look at the funds and what they are trying to do. So if you look at negative months, we find that whenever index is down, on the average, Fund A has given -5%, E is -3.6. It is low for D and I, which means they are clearly conservative. But for T, when the index is negative, it is actually delivering still a positive number. Now, this is clearly a demonstration, when you're doing the positive return, when the index is negative, that you have deployed some of the strategies which are getting delinked to the market. And this is helping this fund for sure. If you look at I also, its beta profile is quite low. Its returns whenever the markets are down is, it's a very small negative number. So even Fund I is probably doing something, some good active hedging, because of which it is demonstrating very good risk control. So we are seeing that, out of these 5 funds, we are seeing that at least 2 are deploying these, long short strategies quite aggressively and effectively. We have a Fund D, which is conservative, but, its returns are not catching up. So which means that essentially this fund is probably conservative in nature. We can't really comment on how effectively they are deploying the long short, strategies. But it is clearly demonstrated in for T and I. And so we'll have to dig deeper. Now, if we look at the performances on financial year basis, and when the market crashed, it was I which did exceptionally well. It hardly went down, and the markets went down by 22% in that month. E and A have greater linkage to the market, so they kind of fell along with the market. Others did okay. In next year, FY21, when the market rose sharply, the Fund A, which has the highest linkage to the market, did best, and followed by E. And in this year, even Fund T has done well, although its linkage to market, is not strong. Then FY22 till date, all the funds are doing quite well, and they are pretty close with each other. But what is noticeable here is that for FY20 or March 20, I did best. For FY21, A did best, and FY22 till date, E is doing best. So we see that T, which actually has the massive lead over other funds, is not featuring as the top performing fund in any of these 3 scenarios. And what it means essentially is that it is kind of consistently doing well, but not the best in any of the scenarios. And it is a good learning. It's a good observation for us to keep in mind that, probably the fund doesn't have to deliver top performance to be the top fund over a long period of time. If the fund is doing well enough, or let's say it's, doing well in all phases, it will stand out over a long period of time. So this is interesting observation here, and this is something that we'll discuss more, as we go through this discussion. Now, I want to also discuss very briefly about, how to choose right funds. So we have seen, the significance of, let's say very briefly, we have understood the significance of or importance of, delinking our returns with the market. So it's possible to make returns, even as the markets may not be doing so well. And it is getting demonstrated in the performances of some of the long short funds who are supposed to deploy some of these strategies. But we can also find some of these linkages even in long only funds. So how should an investor, select a fund or choose a fund? Again, this is my all personal view. In my view, the funds that aim for alpha, that aim for lower volatility are better. I will explain you why. But if you consider, let's say, a good year, when market rises about 100%, and in second year, subsequent year, it falls by 50%. So you go up by 100 and you fall by 50. You basically come to the same spot where you were. So it's very important to understand, how the funds are managing the risks. So to check the risks of the fund, I think there are very handy ratios like volatility in monthly returns or daily returns, and the beta profile of the fund. Lower the volatility, lower the beta, the better it is. And if you look at even in long run, I think some of the funds which demonstrate low beta profile, low volatility profile, they will outperform the markets. I think the evidence is already there, and the funds, as an investor, you have to be looking at these kind of funds. Then I believe that as long as the fund manager is looking for those alpha ideas, he'll get those independence in returns relative to the market. So how to check whether the fund has got any independent returns relative to the market? So I believe that if you look at the what are dependent returns, so your beta of the fund essentially talks about your sensitivity of the fund returns to the market, or the linkage of the fund to the market. So if you multiply the beta of the fund to the market returns, you will essentially get how much of those returns that the fund has made are linked to the market. So if you reduce that from the actual returns, you will get the delinked portion of the returns, or the independent portion of those returns. So the greater the independence of these returns relative to the market, the better it is. It means the fund has not really played too much on the market. It has looked for the ideas which are doing well, which will do well irrespective of the market conditions. The important thing to understand here is that markets are not in our control. They could go up, they could remain flat, they could go down, and we also operate in an environment where our markets are linked to global markets. We are not working in isolation. So when we saw the crash in 2020, the whole globe was coming down, and when we saw the rise, the markets all over the world have risen. So we can clearly see that there are strong interlinkages, and hence the market behavior is essentially something that we cannot control. So more you are generating independent returns for the fund, the better it is. You don't want your money to be completely driven by market. You want returns to come to you irrespective of the market, and that is why you pick up active funds. Otherwise, investors can always go for passive funds. One of the most important feature to check or evaluate a fund is how they have done in a weak market condition. Now, what happens typically is that in a bull phase, everybody shows their performances, and we kind of talk about XYZ fund which has given 100% plus returns and so on. While those must be really good funds, but it's possible that some of the underperforming funds relative to the index, who have been underperforming relative to the benchmark, they have been simply underperforming because they are taking less risk. They are not participating too much in the market frenzy. So a better idea to evaluate the fund is how they have done in a down market. Instead of checking which funds are better performing or best performing in bull markets, you should look at which funds are doing better in bear markets or weak phases, because those are the funds that are managing your risks better. Those are the funds that are trying for those alpha stocks and trying to get you more stability. And in long run, always remember that the more consistent your returns are, better your compounding will be. If you make, let's say, 10% compounded returns for 2 years, you will land at 21. If you instead, let's say, make 30% in 1 year and then minus 10% in another year, you will be far worse off. So you will land somewhere around 17 odd or so. So it's always better to aim for funds that can give you more consistent returns. And the test of real fund management skills or portfolio management skills or investing skills comes only in the down market. How your quality companies or your good companies are holding, and they will always be demonstrated. In a rising market, anything can rise, but in a falling market, your bad companies or bad stocks will definitely fall, but your good companies will hold the ground. So a better way to evaluate funds performance is always look at the funds which are doing well in bear market conditions, and you can kind of, let's say, assign lower weightage to the funds that are doing well in a bull market scenario. So I would always go and look for the funds that have done better in a bearish kind of scenario. And our last aspect is to check, which the soft aspects of the investment team. Now this is something very very counterintuitive in many aspects, but you should always try to talk to the investment team, see what their thought process is. If the investment team or the fund manager talks more about market timing or what the market levels would be, uh, rather than talking about the stocks that he feels passionate about or he wants to have in his portfolio. So it's kind of an indicator that the focus is more on market timing rather than alpha. So fund management focus should really be on the alpha generation, not on market timing. Markets, anyways, are not in control of anyone and beyond anyone's predictability, really. So it's better to just focus on good companies, alpha stocks, which will do well. And if the business traction is solid in them, just hold on to them. Then you should look at managers who talk about processes, who talk about risk management, who talk about how they have built the analyst team, how their processes have become unbiased. They will not allow any biasness to come into stock selection, or they won't go kind of overweight too much on a sector. So all these fund managers who talk about processes and risk management, they will be better off than the managers who will talk really bullish about India. While the story of India is fairly bullish, but it's something that everybody knows, and is perhaps already there in the market and stock prices. So it'll always be served by the managers who are process driven and risk conscious, rather than the ones who will talk bullish about equities and so on. Now, the other point is that you should actually look for fund managers who are kind of bearish in nature rather than bullish. Now, this is very, very counterintuitive and controversial, but it has been my personal observation that bearish managers, their thought process is that out of 3,000 companies or 4,000 companies in the market, most of them will lose money or they won't do well as in terms of business. There'll be only select few where the corporate governance will be very good, where the businesses are very good, which have pricing power. So they will be focused on identifying those businesses, but they would be by and large be somewhat cautious or bearish on the overall market. And if you are bearish in your thinking, then you'll be far more selective on what kind of companies you want to own, and that will make the whole risk management process better, and the stock selection even better, as against managers who are very very optimistic about the markets or the country and so on. It's possible that they might get complacent a bit in selecting the right stocks. We'll discuss about Warren Buffett as the guru of Warren is only one. So I worked closely on US markets and followed his investments, and I kind of believe that his stock picks indicate that he is actually very bearish in mind. So if you look at his stock picks, what kind of stocks he picks. So let's say he buys Coca-Cola, he buys McDonald's, he buys Gillette, he buys railroads. So there is a pattern. He's buying kind of defensive companies which he believes will not die. They will survive, and they should be like market leaders. So if they are market leaders in a defensive segment, that will continue its business forever. So he tends to think which companies will survive a 30-50 year horizon. He's not so worried about growth. He seems to be worried more about survival, and that defines his stock picking, and it has served him really well. So I remember back in 2007, and this is just before the global financial crisis. there was strong buying happening by Berkshire Hathaway in railroad stocks, US railroads. So railroads are basically, this is just an example. So like in India, the rails serve both the passengers and the goods, but in US it's predominantly serving the goods market for transportation of goods from one part of the country to another. Their passengers essentially use either cars or they use airlines. So if you imagine the railroad business, which takes goods from one places to another, uh, the drift, let's say, or the growth pattern in their business is simply linked to the economy, and it is also somewhat, less sensitive. So if, let's say, economy is doing well, the transportation of several goods, will be linked to the economy by and large, and the growth will be somewhat less relative to, let's say, a company which could have an exponential growth. So Warren was buying those railroad stocks back in 2007, and that too he was buying in a very very large quantum. So he owned, like, in couple of companies he owned more than 15%, and he was probably trying to merge the two. And at that time, I remember almost every single analyst on the street had a sell recommendation on railroads, very simply because there wasn't much growth potential for railroad as they saw it, and the valuations looked fairly full. But Warren was buying aggressively, and it served him quite well when 2008 crash happened. You know, these are the businesses which are cash rich and do not go into loss as much, and there is nothing that can break this business in long run. The rails will be there, they will be used for transportation, trucks will not compete with them. And if you look at those railroad stocks, now, while it's a very very simple and a boring business, but those stocks have done phenomenally well. Not only they withstood the 2008 crisis really well, after that those stocks have appreciated very 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 significantly. So it's that kind of thinking, that allows you to become a better stock picker, be more alert and less complacent about what you're buying. So I would go with this, that bearish managers will probably take care of your risks and be very very cognizant of what they are having in their portfolio, and which will serve the investors far better, as against bullish managers who believe in the markets overall returns will be outsized over a long period of time, and hence they could be somewhat complacent in buying the companies that they are. And it's possible that those companies do not do well when the economy turns down, and economy, again, like market, is not in our control. And last point is, about new school versus old school. So again, there are fund managers, who are very valuation centric, who like old type of businesses, old economy kind of businesses. So those strategies have really struggled. Value strategies have really struggled. And in an environment where, let's say, your interest rates have fallen so low, where your European yields or government bond yields are gone into negative zone, your US yields are at 1.3. Valuations don't mean much. So your new school kind of fund managers who are far more open to new ideas, disruptive businesses, technology oriented, who are more growth focused, and looking for the businesses which are operating in oligopolistic structures with pricing power, they are they kind of will do better, in my sense. And it is actually one of the reasons why, in fact, Warren Buffett has been underperforming over the last 4-5 years, and quite substantially, because he is still not aligned to the new tech kind of businesses, and those businesses have done very well for the US. So these are the broad points that I wanted to share with you, the strategies as well as how to deploy them. I will be very happy to take your questions from there. Thank you.
Right, Harsh, this has been really insightful. So if you could just stop the screen share, we'll start the Q&A.
Yeah.
Right. So for the audience, I would first of all, thank you for your patience, because as most of you were writing in the chat, that presentation was actually looks like it was meant for fund managers, because this was little technical. However, I can tell you a lot of interesting points have been made by Harsh today. And let me also, give you a perspective that because this session was about discussing long short funds, which come in the alternative investment funds category, and these are governed by private placement norms, where hence that we have to do session in a more educative manner, and we cannot particularly discuss any particular product, and so we have not named any product, and we are not trying to sell any product, but we are trying to educate the audience out here. And moreover, the fund category is such that it requires us as stakeholders from the ecosystem to educate the audience, whether it be advisors or it be clients. There is definitely less understanding about some of these strategies, and that is where I really thank you, Harsh, for having put and gathered all this information. So the first question, that I can gather from the understanding of various, people we have in the audience. So, throughout the discussion, you have talked about FNO, you have talked about derivatives, and we have been talking about basically long short funds, which are SEBI regulated and which are where obviously these are not meant for trading; these are meant for investments, and time horizon could be 1 year, 2 year, 3 year, 5 year, depending upon investor to investor. However, how risky are they? Are the understanding, basic understanding about alternate investment funds is that they are relatively less risky than long only products. Could be
Of course.
PMSs or mutual funds, right? But because you have been throughout talking about use of derivatives, it comes out and it seems that the risk levels are more. So can you kind of put light and explain and kind of clarify the context?
Yeah. So I think that's a very fair question. So like we have, seen in the performances, the volatility or the beta profile of these long short funds was much lower, and even in the down months, they were responding, far less relative to Nifty. In fact, one of the fund was actually generating positive returns even in, when the Nifty was negative. So this clearly demonstrate, that these long short funds are actually a lot less risky than long only products, and simply because they're not going 100% long, they are going long on something, they probably are going short on something. So that sort of reduces your overall exposure to the market, and hence the overall linkage to the market, and hence your lesser risk. Now why how derivatives is being used, or why derivatives are, let's say, less risky? So derivatives are not, let's say, any higher risk than equities. It's really how you use them. So if you're far too greedy, you will probably end up taking wrong positions in derivatives, which will lose you money. I'll give you an example. Let's say if you have 1 lakh rupees, you go out and buy Reliance's stock, and for the full amount, and let's say Reliance's stock goes down by 10%, so you will lose 10% of your investment. Instead, if you choose to go to derivatives market, you buy, you put 1 lakh rupees margin, you'll probably get an exposure limit of 3.5 times. So you will be able to buy 3.5 lakhs worth of Reliance for 1 lakh rupees investment. And if the stock goes down by 10%, you will end up losing 35% of your investment. But at the same time, you had the choice that if you're bullish on Reliance, you could buy Reliance. But to, let's say, offset the market related risk, you probably shorted 1 lakh rupees of Nifty as well. Now, as Reliance stock goes down by 10% and market probably goes down by 11%, you will still end up making 1% positive returns. So, it's really about how you use derivatives. Derivatives by themselves are not risky at all. They are, in fact, used more as risk mitigating tools. Also, you should bear in mind that while markets, they when they are going up, they are creating wealth for the investors, and when they are going down, they are destroying wealth for the investors. But derivatives don't do either. They are a zero sum game. Basically, there is a buyer at one end and who creates a long position, and there is a seller who creates a short position. So at the end of the expiry or the market cycle, one will be at winning end, one will be at losing end. So it's essentially a zero sum game. So neither wealth will get created nor destroyed through derivatives. You can only manage your risks or your positions where you feel you want to bet. But market is where either the wealth is getting created or it is getting destroyed. So it's important for the investors to keep this in mind. So whenever they are taking positions in derivatives, they should not leverage too much. They should definitely not leverage in the same direction. So which means that you have 1 lakh rupees, please don't go long by 3 lakhs, nor do go short by 3 lakhs. That is, taking higher risk. Try to have some, try to have some long positions. If you feel that the stock or the company is doing really well, you could, probably hedge it against Nifty. Your returns outcome will be range bound. In this case, you will probably make 1 or 2% or lose 1 or 2%. But if your skill in, let's say, understanding of the company is good, and you buy the right stock in derivative, it will over a long period of time it will give you some returns.
So during your presentation, you had also mentioned your view on India's economy, and you highlighted that India's economy is expected to continue to doing well, right? For long-term investors who have accepted equities in asset class and who have a goal of creating wealth over long term, what is the positioning of these long short funds, long bias long short funds? Can these long bias long short funds actually add up or complement a long only portfolio for long term investors?
Uh, so there are two parts to it. One is how these long short funds are positioned. So like we had seen that there were 5 funds, and some of them were aggressive in nature. They were more linked to the market, so they are trying to kind of beat Nifty returns. And I think one of them has been able to beat Nifty since inception. The others were more conservative in nature, so they are trying to get more consistent returns. But this is something very similar to saying that if, let's say, market's outlook is very very good and strong, then why should we have a balanced category or balanced advantage fund category within mutual funds parlance? If market keeps doing 15% per annum, then these categories will always underperform Nifty, right? But there is a different appetite. There are investors who don't feel so positive about the market, who are somewhat risk conscious, who want some steady returns. So they kind of look for these hybrid options, which gives them some stability and also some kind of market aperture. So you will have to see the long short funds which are equity oriented in these, in this light, that some of them are kind of balanced advantage funds, and some of them are kind of aggressive hybrid or Nifty kind of funds. And then you will have to compare the performances of these funds relative to what they are trying to do. So I think some of the funds that we saw, the T and I, they were doing phenomenally well, as I could see from prima facie from their numbers. So their volatility or the beta profile was even lower than maybe a balanced advantage fund. I think their returns were better. And one of the funds in the risky category was actually doing better than Nifty since inception, as we noted. So they are doing better than the benchmark, and I think the idea here is that, uh, you know, basically these long short strategies, they allow you an additional tool of capturing the short alpha. Like I explained in the example of Maruti, while the markets went up nearly 12%, the stock went down 10%. And that is how you generate short alpha. This optionality of short alpha is not available with long only funds. And hence, if, let's say, the funds are able to capture this short alpha, they will do really well over a long period of time. There is absolutely no doubt in my mind that these funds will definitely beat whatever their respective benchmark is, whatever they are positioning themselves to be. But a good strategy which captures both long and short will beat markets over a long period of time. There is no doubt about it. But you still have to see how these skills are getting deployed. While funds have the tools, but it's not that they may have the skill set for using those tools effectively. So you'll have to run through their numbers, you'll have to see their performances. So if the fund is taking less risk and making good returns in a bull phase, then it is a definitely they are doing something on the alpha side, both on the long side and the short side. So you have to kind of look for those kind of funds, and look at your risk appetite, and accordingly choose those funds.
Sure.
But because of this short alpha, capture, they will do better generally
Sure.
than their respective risk categories.
Sure, sure. So for the audience, I would simplify and kind of clarify what Harsh has explained. So basically, what happens in the long only side of investing, one is making money aiming to beat Nifty. For example, if Nifty is the benchmark, of say Nifty 500 is the benchmark on the upside. But what happens over a 3 to 5 year cycle? Market doesn't just goes upwards. Market shows a downtrend also. Long only products would rise with markets and would fall with markets. And if those long only products which have say beta closer to 1, they will ideally go in line with the market on the upside and downside. But on the other side, during this 3 to 5 year period, a long short fund would try to aim to deliver equivalent return while markets were rising, and they will try to definitely protect the downside when markets were falling. And if we imagine a period of say 2018 to 2021, where markets actually went down 40% and then went up 70%. So those long short funds, which while markets went down by say 20 to 25%, and hence generated alpha on the downside. And while markets went up by 70%, they went up equivalent to market, or say went up by say 60, 65%. Obviously, in the absolute terms, they would have delivered better returns. And that is where over a 3 to 5 year period, long short funds have a possibility of generating returns. And especially now, because markets are at all-time high. And there is a fear factor which many investors have, and that is true, because obviously over years, and history tells us that equity doesn't only go up. There will be time over next maybe 1 year, 2 year, where markets will see a downtrend. And that is exactly where a skill set of the fund manager plays a role. We actually invited Harsh to talk about these strategies in the long short category, because the fund that Harsh is managing is showing consistent performance. And maybe now I come to the question.
Now these funds probably fell less. It's actually possible for these funds to make money even when the market falls, if you kind of equalize your longs and shorts, or maybe enhance your shorts over longs. Then you're gonna benefit when the market falls. Having said that, market timing is not so easy. Even mutual fund managers have the option to hedge their long positions completely and create an arbitrage over their existing positions. But it's not easy to time the market. But what we have seen, these long short funds, they definitely do better in the down phases. And so you really don't have to capture 100% of the upside of the market. Even if you're capturing about 50% of the market upside, and you fall by, let's say, 20% related to the market when the market falls, you will definitely be better off than Nifty or the markets overall. So I think most of these funds are trying to do that. They're not trying to capture 100% of the market upside when the market is rising. They are probably looking at 50% kind of participation on the upside. But when the market is going down, they don't want to participate more than 20%. And that is what is positioning them as low risk, low volatility, but good return funds. And over a long period, we have seen that some of the long short funds have actually beaten Nifty quite comfortably.
Right. So, Harsh, though in your presentation you have covered and explained more maybe in technical terms. So, in simple terms, if I want you to kind of explain your skill set, right, your style of managing money in the long short fund, assuming that an investor has given you 1 crore, which is the minimum ticket size in the alternative investment fund category, right? You can assume say 100 rupees has been given to you. So how do you really structure, and what is your style, and what happens from investors' perspective?
So the way the 100 rupees will get deployed, it depends on the fund structure, not my style structure. So if, let's say, the fund is positioning itself as, let's say, balanced advantage fund, something similar to that. So it will park a portion of that money into equities, balance into fixed income, and then it will create a layer of long short portfolio, and it will try to capture the short alpha through the derivatives long short, and some of the long side trades will also get captured there. So what it will essentially try to do is make a BAF kind of a structure and create extra returns through a derivatives portfolio over and above it. Similarly, if you have aggressive kind of investment structure in long short, you will probably deploy about 70-80% in equities and for the balance, you will create a long short derivatives portfolio and try to make some extra returns out of it. So so this so person's own style does not influence how the fund is structured, but let's say your skill set will influence what you will do in it. So my skill set is essentially in alpha, selection, and identifying which stocks will outperform, which stocks will underperform. So my funds will have a lot of positions in on the long and the short side, and I'm trying to capture both the sides of the play. So what market is going to do is sort of less important to me. That is taken care because of how you have designed the fund. So if it is positioned on balance advantage fund, basically park 50% of your equities there and do long short, from the remaining 50. If it is debt oriented kind, then park maximum amount in a pure long short, and put everything underlying in the fixed income instruments. So you can design any kind of product, in long short, and that's really the beauty of it.
Right. However, while you are saying that one can design any kind of style in managing, can all these styles be performed by investors themselves on their portfolio, or you're conveying from fund managers' perspective?
So investors can definitely learn, about these styles. So there is a lot of content and literature available on the internet, and there are books available to understand these. So you can definitely learn at your individual capacity, but it will take years to really build a skill on it. And you will not come to know whether you are a good long short fund manager or a portfolio manager until you have ran the money for a substantial period of time. So you will have to do a lot of experimentation with your own kind of money, and you probably will lose a lot of money before you develop a sense of the market or the skill in it. So it's a fairly difficult task to do. I would say that theoretically you can learn, but it will be very very difficult to get trained on it and actually profit from it over a long period of time. Yes, some individual investors I know, they are doing technical analysis, and they use options mostly, to make money on their individual side. So something that requires less, let's say, less understanding of fundamentals can probably work. More understanding of price movement and technicals, that can probably work. But when you're looking for a strategy that is very very dependent on fundamental news flow, it will be very difficult for the investors to do it on their own. They will be better off, looking for managers or the portfolios which can do it, who have the necessary expertise to do it.
Right. Again, I would just like to clarify for the audience out here. We have been discussing about long short alternative investment funds, right, which come with minimum ticket size of 1 crore. And many investors here have been asking questions that do mutual funds also follow long short strategies? The answer is no. The balance advantage funds do not follow long short strategies. They are basically, as the name says, balance funds. They take, advantage of balancing between couple of asset classes, right? And obviously they are conservative equity funds. However, pure, long short style of investing requires derivatives, and that is allowed only in the AIFs. And these are governed by SEBI, and under SEBI's governance and SEBI's policies, these funds are managed. So it has been really insightful talking to you, Harsh. Your time, I think, has been very worthwhile, and I personally enjoyed interacting, and I have learned a lot. I think writing an article out of whatever we have learned will be very very meaningful. Before we just end, I would just like to understand from you, because I have always asked many questions about economy, market, sectors from long only fund managers. Now you are a long short fund manager, right? Maybe long only fund managers always give a positive view because they are long only fund managers, so they have a bias, right? Today equity markets are flying and only flying on only on one side. So I am very curious to ask your view on economy, your view on markets. Why is market rising? Where is market headed? And any particular perspective you can give on sectors, economy, small cap, mid cap, large cap. How would you manage your money at these levels? Over to you. And this is the last question, and then we will end.
So our topic of today's discussion is how to generate returns which are not linked to the market, which are not so dependent on the market. So, to honor that topic itself, I should not be answering this question. But I'll just give you a small perspective to it. So, instead of looking at, what markets might do in future, we should probably look at, what it has done in past and why it has done what it has done. So if you look at returns from, let's say, 2010 onwards, so I'm taking 2010 because 2008 was a crash year, and then 2009 was a rebound year. So we rule out both those years, and if you were to go in past, then it kind of loses meaning. So your returns trajectory, what is going to follow, is more likely to follow what has happened in recent past than what has happened 20 years behind. So if you look at returns from 2011 till now, Nifty has probably given around 12% compounded average returns, and that too when the market is standing at a very, 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 very elevated level in terms of valuation. So your future returns will be somewhat weakish than what it has been historically. That is my sense, and it's purely because your starting point in terms of valuation is very high, and it's kind of justified. The high valuations are also justified because you have to look at the valuations of other asset classes to understand the valuations of equities. So valuation of all other asset classes is very, very high, and if you were to look at the building blocks, so your essential building blocks for valuation of equities is how your interest rates are in the economy. And when you look at Indian interest rates, and then those again are influenced by what is happening globally, and especially in the developed world, so where the interest rates are 1% or even 0% for European bonds. So when you have 0% kind of interest rates, valuations sort of lose meaning to a certain extent, and hence every asset class goes very, very high and can see any kind of valuation. So valuation per se, high valuation per se, does not mean the market is going to crash. It only means your starting point is high, and your ending point now will basically be dependent on how fast your earnings grow, and market is probably already discounting FY23. So how the earnings grow from FY23 onwards, that will determine your market. In fact, the outlook for earnings from FY23 onwards. So that will decide how the market probably moves up. But further re-rating will be difficult because it's already starting at a very, very, very high point. But I think investors should understand that these are the times when everything is expensive. If they were to reduce the allocation to equities, there isn't a very good alternative to place your money. And which is why it is also more important now to appreciate the concept that there are products or strategies that can make returns without market influence. And if they can make you decent enough returns, those are the strategies where you should put more allocations to. There isn't while everyone has some kind of exposure to the markets in fixed income also, you should look at something that will give you steadier returns and better returns. And I think these long short strategies are very good very good avenues to park your money. If let's say market remains range boundish, let's say 10% kind of returns in future, then these strategies which are looking for dealing kind of returns, they probably will make more than that. My guess is around 12 to 13% is definitely on cards for these long short funds if the markets were to make about 10%. They obviously underperform the market if market shoots up by 50% because they don't take that much risk. But they do have some kind of absolute character to their funds because they are looking for these strategies as well. So it's definitely a scenario where next decade probably will be very favorable for long short strategies for the hedge funds, not just in India but globally. That is what I see. And from from let's say producers perspective or distributors perspective also, it makes a lot of sense to focus more on these areas because your fixed income earnings are low, your equities are high. So basically you're looking at, let's say, lesser returns versus what they had been in past for the next decade, and hence it's good time to focus on these kind of strategies as well.
Right, Harsh, well said. And I think, as you mentioned, this is good time to definitely learn and consider some of these strategies. And that is where, we organize this talk. We also believe in the same. Thank you everyone for your time, and thank you Harsh for giving us your time today. I'll catch up with you again maybe once more after a couple of months. Then maybe we would have witnessed either a 20,000 level on Nifty or a 15,000 level of Nifty. We don't know.
Hopefully, yes.
Right. Thank you so much.
Thank you, everyone.
Thank
Have a
you.
nice day.